Should you buy real estate or set up an automatic monthly investment plan in the stock market? That's the classic question millions of Americans ask every single day. Both sound smart, both sound safe, but over the long haul, which one is actually going to build you generational wealth? To understand this, let's look at a simple story. Imagine a hard-working guy who clocked in for 35 years, paid off his mortgage, saved what he could, and finally retired. Now, he wasn't a multimillionaire, but he had a solid nest egg. He called his twin sons over and said, "Boys, here's $150,000 each. Go build your lives." Exactly equal, no favorites. This is where it gets interesting. The first brother immediately says, "I'm buying land. Dad always said real estate is the safest bet. They aren't making any more of it." The second brother was a bit more analytical. He thought, real estate is cool, but I want my money to work for me automatically. So, he decided to set up a recurring investment plan into index funds. On paper, both sound pretty smart, right? But this is exactly where their financial paths violently diverge. Brother won the real estate route. He didn't overthink it. He found a nice plot of land just outside a growing metro area for $150,000. He figured in 10 to 15 years, that area would boom and the property value would easily double. Honestly, that's not bad logic. We've been told for generations that real estate is the ultimate asset. He dropped the full $150,000 upfront, paid the closing costs, property taxes, and title fees. Now, he owned a piece of dirt. No monthly stress, no watching the stock market ticker just by and hold. Simple. Brother to the automatic investing route. He took a completely different approach. He said, "I'm not putting all my eggs in one basket." First, he took $50,000 and parked it in a high-yield savings account as an emergency fund. Why? Because life happens, job losses, medical emergencies, or recessions. If all your money is locked up in an asset, you're forced to sell at a loss when a crisis hits. That left him with $100,000. He didn't drop it all at once either. He set up an automatic monthly investment dollar cost averaging into low-cost equity index funds. Month after month, whether the market was up or down, his money was deployed automatically. Brother 1's money was sitting idle in a plot of land. Brother 2's money was directly funding the biggest corporations in America. The 5-year check-in. 5 years fly by. Let's look at the scoreboard. The land investor. Real estate growth is 100% dependent on location. Scenario: a prime location. If he bought in a booming suburb with new roads, schools, and commercial tech hubs coming in, a 10% annual appreciation is totally realistic. In 5 years, his $150,000 plot would be worth about $240,000. That's a massive $90,000 gain. Scenario B: speculative location. If he bought way out in the boonies, hoping the city would eventually expand there, growth might only crawl at 5% a year. In that case, his $150,000 is only worth about $190,000. And once you subtract closing costs, property taxes, and maintenance, his actual profit is even lower. Real estate pros and cons. It's a tangible asset. It doesn't crash 20% in a single day like a bad stock market headline. It's a great hedge against inflation. Down the road, he could build a rental property on it and generate passive income. But the downside: zero cash flow for the first 5 years, and it's completely illiquid. If he needs cash tomorrow, he can't just sell a corner of his dirt. The index fund investor. He kept $50,000 safe and liquid for emergencies. The other $100,000 went into the market. Historically, the US stock market delivers an average 11% to 14% long-term annual return, but it's a roller coaster short-term, at a conservative 12% average annual return. His $100,000 portfolio grew to $176,000 in 5 years. If it was a roaring bull market 14%, it hit $193,000. If the market dragged 9%, he's sitting around $155,000. Market pros and cons. The stock market forces you to face volatility. Some days his portfolio was bleeding red. Other days it was bright green. But his secret weapon was dollar cost averaging. When the market crashed, his monthly investments bought shares at a discount. When the market went up, he bought fewer shares. At year 5, the growth feels incredibly boring. Why? Because compounding is like a snowball. It requires a massive base before it starts looking impressive. At this point, there is no clear winner. Land in a great area might actually look better than the stock market, but the real magic happens in the next phase, the 15 to 20 year showdown. Let's fast forward the tape 15 to 20 years. This is where compounding goes completely wild. The land investor assuming a solid 10% growth rate. At year 5, it was worth $240,000. By year 15, that steady 10% compounding pushes the land value to $620,000. By year 20, that $150,000 plot hits a staggering $1 million. Turning $150,000 into $1 million sounds like an absolute home run. But remember, if you picked a mediocre location that only grew at 6% a year, that land is only worth about $500,000 after 20 years. Location is everything. The index fund investor assuming a standard 12% market return. Remember, he only started with $100,000 in the market, keeping $50,000 liquid. By year 10, he's at $310,000. By year 15, he hits $550,000. By year 20, he lands right around $960,000 to $1 million. But what if the market hits a strong historical average of 14% over those 2 decades? By year 15, he's at $710,000. By year 20, his stock portfolio explodes to between $1.35 million and $1.4 million. The sneaky power of compounding. Notice the shift. For the first 10 years, both brothers looked neck and neck. But between years 15 and 20, the index fund investor's wealth starts pulling away at warp speed. Why? Because of the chain effect of compounding. When a 12% return applies to a small amount, the dollar growth looks tiny. But when 12% hits an $800,000 portfolio, your money makes $96,000 in a single year without you lifting a finger. The next year, that 12% hits an even bigger number. With land, your growth is generally linear and steady, unless a massive highway or commercial mall suddenly gets built next to it. But with automated stock investing, every single dollar your money makes instantly starts making its own money. The mistake isn't choosing real estate, and the mistake isn't choosing the stock market. The mistake is investing without understanding the mechanics of time and liquidity. Real estate gives you a hard, physical asset with zero daily emotional stress, but it locks up your cash. Automatic index fund investing gives you unmatched long-term compounding and total liquidity, but forces you to tolerate the emotional roller coaster of market swings. The ultimate secret to wealth. It isn't picking one over the other, it's starting early, staying disciplined, keeping an emergency cushion, and letting time do the heavy lifting.